Welcome to the October 30th, 2023 Advanced Report for McGowan Group clients and NetWorthRadio.com listeners. The top question this week, the title, 4 Years in the Desert. So I want to cover something about the Dow, the equity markets, and of course the economy and earnings that go with it. But it's a very important concept because this is the 9th longest flat period with drawdowns in the markets in equity market history for the U.S. Now look at this. This is 2.5 years in the desert. The Dow descended here in October to the same price as March of 21. Now if you go all the way back to February of 20 before the shutdown, you've only got a 3% average appreciation for that 4-year period. That's why I titled it 4 Years in the Desert. Now when that happens and then earnings start to grow, you get something like a 2012 where you start to see major advantages because you create bargains in that long flat period, that long drawdown period, if you will. And we want to talk about those bargains with a little more specificity as we go through. Now, I'm Spencer McGowan, President, McGowan Group Wealth Management, your financial weatherman with the weekly fast-paced tour of the global financial markets. McGowan Group Wealth Management brings this as proof that we love our clients and we want to help them make great decisions in the year ahead. We serve affluent families right from the Crescent in Dallas by Zoom, phone, email, and of course in the office for tours and plan updates. So we look forward to working with you. Now let's go to the next is the QQQ. It's a very bad week for the Magnificent Seven. The NASDAQ 100, the 7 largest companies, including Microsoft, Amazon, Google, and Facebook, those companies actually make up 50%, the Magnificent Seven big tech. Boy, they took it on the chin. Google disappointed on their earnings, and boom, they took $200 billion off the value of the Magnificent Seven this week. So it calls into question the fact that if you had an equally weighted S&P portfolio as opposed to capital weighted, then you're actually negative for the year now, and the Dow's down 1.5%. So October was disappointing, but something is happening on the positive side behind the scenes. This is GDP growth. Now this shows 2.4 for the year, but actually the third quarter growth accelerated to 4.9%. And this is why you subscribe to McGowan Group YouTube, because we said it long before. Our best research source told us 2 months ago that GDP was running at about 5% or 4.9%. And that said, hey, the economy's pretty good. That helps people to make great decisions. We had an earnings recession. For 18 months, S&P 500 earnings had been down from their peak. And that's happened before. This is 209 companies out of the 500 S&P companies. Earnings growth is a strong 11%. We reported last time, Yardeni Research, one of our best sources, says S&P operating earnings likely to go up by 20% by the end of 25. Now, if the Fed starts to lower interest rates, as their forecast says they will over the next 3 years, you take earnings growth at double digits, you've got a prescription for a potential magic carpet ride in the markets after an extended flat period. That's really exciting. Here, I wanted to cover auto loan delinquencies because there was a big article on subprime delinquencies hitting the highest since like 2007 or 2008. So I wanted to graph overall auto delinquencies because the subprime market is very small. Well, here, this is 2009, delinquencies ran over 10%. That's a lot of cars being repossessed, a horrible economy. Where is it now? 7%. Where was it in 2017, 16, 18, 19? Pretty good economy. Wow, it was actually below where it is today, but about the same. So you really don't have excessive delinquencies. Let's look at credit cards. Credit cards, they're about where they were in 2017, actually a little bit below. So it's not as if they're flashing that it's a bad economy. This is a bad trend, and that's why the headlines are there. If it continues, well, you could see the maximum delinquencies in 2009, quite substantial for the credit card market. So we're keeping an eye on that, but right now it's not at an excessive level compared to normal. Here on the oil chart, we're at 83. So I wanted the 3-year oil chart here just to get a perspective. There's the invasion, you hit 120. JP Morgan predicted that oil could reach $150 a barrel in this cycle. And you could see the 65 to 95 rally right here. Technically, you gave back about half of that, which is normal in a technical trend. It's holding 83 to 86 at the current time. But those companies are trading at about 5 times cash flow. And that's true of the majors. It's true in the exploration and production. Some companies are 3 times cash flow, which is why you saw 2 huge mega deals. That first was ExxonMobil buys Pioneer, and now Chevron just bought Hess. Both of those deals between $50 and $60 billion. So that was that's the beginning of what looks like a lot of mergers in the space, raising that multiple potentially from 5 times cash flow to maybe 10, especially if oil goes to 150. Now this chart is the Dow, and when is it? It was the last dreaded government shutdown. That was the other question on this week's teaser on the text. Government shutdown, run in circles, scream and shout. Now this is going to sound familiar. In December of 2018, right back here, we had a Fed tightening bear market cycle. Sound familiar? And the S&P was down 20%. Then the government shut down in December, right about the Christmas meltdown. The Fed says, okay, we're going to pause, but we'll probably do 2 or 3 more rate increases. That sounds a lot like the Fed right now after a tightening cycle. Then the government shut down for its longest period ever. 35 days the government was shut down. What are we going to do without government? Now, if they solve paying the military in the meantime, and negotiate, government shutdowns aren't necessarily bad because the government shut down right here, and by the end of the government shutdown, well, you were back above where the S&P was and the Dow. You recovered all of that plus some, and then you went on even up higher. So the government shutdown time period wasn't negative for the market at all. Thank you for tuning in. Be sure to go to themcgowangroup.com. You can find us there. Send us a message if you'd like to set a time to call. It says contact us, and we can set up your time for a brainstorming session to upgrade your plan for 2024. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the Longer Play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.